Well, Tyler, a couple of the sectors that were mentioned was where we're shifting our asset allocations into it and away from the defensive sectors, financials, industrials, materials, and energy. We think what we're starting to see is a rotation that is legitimate this time, unlike the last couple of times around over the last few years in which it was a one-month wonder. And the legitimacy is really being borne out by some improvement in global economic conditions. Some of those readings that are coming out of the ISM surveys or the Chinese Purchasing Manager Indice figures are indicative of perhaps some stability occurring in overseas markets, which is going to go a long way toward kind of one big trade, some softening in the dollar and improvement in U.S.-based multinationals, particularly those that are more heavily geared towards foreign markets than domestic.
Michael, let me ask you to chime in here. And it seems like you and Mark overlap in your preference right now for what I'd call basically some cyclicals, including financials and others.
So although the economy continues to decelerate and corporate profits have been falling, I think it's important to continue to have sectors of the market that can demonstrate very solid growth. So we continue to like the technology sector, the communication services sector. But Tyler, I do think you need to begin to balance that with some sectors that have been out of favor this year and are starting to respond now. And so for me, I like healthcare and financials. So we're going through what's been a fairly sluggish earnings quarter, and healthcare has been the stalwart. They've done a fantastic job in terms of revenue growth, earnings per share growth. It's an inexpensive asset, and it has some long-term structural tailwinds that should support healthcare going forward.
Mark, I wonder if you think the market is pricing in a lot at this point as we chug along at record highs here in terms of, are the markets discounting the signing of the phase one trade deal? Certainly they're discounting the Fed pretty much remaining on the sidelines because the bar is so high for them to move on rates either up or down at this point. And we've already got earnings pretty much in the books. And I ask you this because once that phase one trade deal is signed, what happens?
Well, I think you're right. I think the market has pulled forward a lot of good news on both fronts, certainly on the trade deal. And just as the phase one is intended to be a down payment on a much broader negotiation, we know the real difficult issues, the structural issues, are yet to be grappled with and probably will take much more than even the next year, if ever, to fully resolve. In addition to that, I think earnings expectations on a year-over-year basis, that is 2020 over this year, are expected to be up, according to FactSet, by about 8.7%. That doesn't seem unreasonable to me, given global growth expectations that we hold for 2020. And therefore, I think the market can continue to advance predicated upon the realization of those earnings. This year's story has been all about market multiple expansion and little in the way of earnings contributing, if you will, to the gains that have been had so far. So a lot of heavy lifting is going to have to be done by the earnings picture next year because the market, I think, is pretty fully valued at 17.4 times forward. So it doesn't mean the advance can't continue, albeit, though, I wouldn't be surprised if we stalled in here a little bit until investors become more convicted around that earnings growth story for 2020.
Michael, we have a lot of political winds blowing these days, not just on China and trade, but obviously with the election coming in 2020. A lot of people in jobs like yours are wary about whom the Democrats might nominate. Does one candidate on the Democratic side worry you more than any others?
I think overarching concerns about the election always get a little bit overblown. And next year could be a similar scenario to 2016, where the market largely treaded water until we got clarity on the election. But, Tyler, I do think that if a progressive Democrat were to win the presidency, the markets would sell off. Now, that's not a political opinion. I think similar to what we saw in the aftermath of Trump's election, markets celebrated on the idea that under a Republican, you'd have lower taxes, less regulation, and a more business-friendly environment. I think under a progressive Democrat, the corollary would be you'd have more regulation, higher taxes, more bureaucracy, and slower growth. So I do think that the markets would react negatively to a progressive Democrat. That would leave you with Sanders and Warren in particular as concerns for the market going forward.